has the 2s and 10s inverting changed your base case outlook to the downside, i.e. recession versus Fed engineered or soft landing?
No. Again, the data is going to change our mind on the direction and the pace of the economy. So you go to slide 27. What's going on? Sorry, my computer's. Actually, I'll just look at that. So no, what we're showing here on slide 27, on the top row is just our the historical and our real GDP growth rates on a year-over-year basis in conjunction with our forecast. The next 10 rows should show the top 10 drivers of our 30-factor predictive tracking algorithm for U.S. GDP growth, inflation, the top 5 factors there, and then just some a look through on profits and free cash flows in the U.S. And what we're trying to show in this slide are two things. One, the economy peaked in 3Q of basically in the middle of the mid to late of 2018, has been slowing since. But more importantly, you see some of these really important drivers of the economy actually start to slow a bit faster than what was initially implied when I made this table, I think 9 months ago. It was green to dark orange to yellow to orange. Now it's green to dark orange to red. And so you start to see some of this global economic weakness spill back over into the U.S. economy, particularly in the manufacturing sector. You look at slide 35, something like factory orders, they're already in recession here. Industrial production, we're going to get that number, I think, on Friday. That could go into recession here pretty in short order. Certainly would be right in line with the data we're seeing out of China. Industrial production slowest since 2002. German industrial production slowest since 2009, down 5.2%. Yikes. These are June figures. So again, we're gonna, the comps only seep. We've been making this point with every single client I've had a conversation with, either via email, via phone, or in meetings. We've been in Connecticut, New York, and Boston over the last few weeks. We're going to get the worst data we've seen since the cycle started slowing back in Q4 of last year over the next 3 months in terms of the June, July, August, and for some of these indicators, the September data just based on the comps. Investors haven't had to deal with that yet. All we've had to deal with is expectations for a Fed easing cycle and expectations that the U.S.-China trade war was it going to sort of blow off the hinges. We actually had a fear that it was going to blow off the hinges last week, or at the beginning of last week, but certainly. As of yesterday, certainly not as of yesterday's performance, that fear has been ameliorated at the margins. What's now happening to futures this morning, what's now happening to bond yields this morning, is they're saying, oh no, the data is getting worse at its fastest pace, and the Fed hasn't done enough to ease. The ECB hasn't done enough to ease. The PBOC is moving in the wrong freaking direction. They're tightening. This could get hairy in a hurry. This is the black hole of market risk we've been talking about for months now. Pay attention.